Right, welcome everyone to this video, and in this video we are going to be discussing on the topic understanding origin block and price imbalance. So when you hear the terms imbalance, it is mainly applicable to institutional traders. So in this very module, we're in module 4 of this course. I'm going to show you guys how you can align your trade with institution during imbalance, or you can call it bulk order execution. When we started, I made mention of a situation that a CBN, I did illustration, a CBN, certain CBN, or any other financial institution come into the market to execute an order of, let's say, for example, $40 million worth of a particular currency pair. I made mention that these guys doesn't execute this order at once. If they execute the order at once, they will cause a slippage in the market situation where price will just move in a single line. The market was not designed to move that way. Instead, these guys usually execute this order in batch, and they leave a footprint that if retail trader can decode and know they're present in the market, you can align your trade with them as they move. So in institutional trading, demand and supply zone are refined areas where large financial institutions initiate or close major positions. These zones represent points of significant imbalance between buyers and sellers. Unlike the traditional support and resistance, institutional support demand and supply zone reveal where or few orders are likely waiting. So an origin block, usually called order block, is the last bullish or bearish candle before a strong impulsive move that breaks structure, creates a new high and low. It signals where institutions first enter and leaving behind footprints of institutional activity. So this takes us to the strategy called the smart money concept briefly. The smart money concept is basically a strategy that outlines institutional footprints in the market. Whenever we talk of imbalance and the presence of institution, you must bring your mind to the smart money concept. So like this, I say something like this is the presence of institution in the market, obviously. This is the present in the market after a brief the consolidation took place before the breakout that we just see in this place. But what I want to show you mainly in this topic, I'm not going to take a long time. This video is going to be short. I will only expose you to one secret. If I can't find what I'm looking for, I'll switch to another page to show you guys right. I've seen it. So when institutions are back coming into the market, you know they are going to definitely break the structure because they have come to execute large orders. So how do you spot the presence of institution? In a situation price was moving this way, this is more like a sideways movement, right? Then all of a sudden you see this sell movement from this resistance top to this level, and then a continuation after a full-blown market structure was formed. So this is what I see, pullback, then a continuation. This is the structure that the market usually form every day, irrespective of the time frame. So how do you notice the presence of institution? That it is institution that is driving the market at this point. You have to, if you are a 1 hour time frame or 4 hour time frame trader, when you analyze the market, if you cannot find the presence of institution, but you are looking for it to spot them on a real-time chart, so you know what to do. You have to look out for the last candle in the opposite direction before the price breakout of a structure. So at this place, this is a structure broken at this point. If you look clearly, you see situation like this clearly. Please, as long as trading is concerned, you have to learn to train your eyes properly. And without knowing how to analyze the market structure, you still have a long way to go. So pay attention. So this is a structure that formed. So the price, this movement, sellers, the pressure was long. Look at the volume. So this the last candle in the opposite direction before the price broke out of that structure is this bullish candle right here. And this candle is called IC, meaning institutional candle. What did I say? The last candle in the opposite direction before the price breakout of the structure, right? So right here, I'm on 15 minutes time frame. So what happens is that how will you know that this bullish candle is the presence of institution? Before you realize that that is institutional presence in the market, the whole of this move might have ended. That is one of the disadvantages of being a retail trader. So what are you going to happen? What are you going to do? The moment price broke out of this structure from this level to this demand level that the price wants to create, then there is imbalance left behind. There is imbalance behind. That is from the breakout structure breakout region, which is this level to the demand institutional demand zone. There is imbalance. So what you do as a retail trader is you have missed all this. You have to come and stay in this place, mark a zone and look for an entry. How do you mark your zone? You take this out. I'll take this out. This is institutional candle, the buy candle. So to get your zone, sometimes you can use what is this tool called Fibonacci retracement. Some people use that. So you have to specify your zone. Use the length of that institutional candle to draft a zone that is going to mark your entry clearly, right? This is the length of the candle from the high and the low of the candle. I've marked my key level. Then take your entry at this point. But our concern is price supposed to tap into this zone, then continue on the downward trend. So this is the presence of institution. Let's say a particular financial institution is going to execute the bulk order. So we have missed this, but we have noticed that present due to the volume of the candle, then they announce that safe at this point, right? The waiting is that market is going to come back to fill this imbalance. So once the price tap into this zone, we're supposed to join forces with institution to push the market from this level to the new low that the price is going to create. And if you look at it properly, you will see a perfect market structure that is formed pullback, the second impulse wave. This is exactly what is happening. So once we miss this movement, this was a break of structure. We are coming here to wait for institution. So at this point, institution use forces with retail trader to push the market downward. So you can see how this sell went. Institutional present, retail traders combined with institution. So this is basically how to trade or spot the presence of institutions in the market. Basically, there's no other basic things that you're looking for. So what I need you to know is that if you see a sharp movement and you're on a big time frame, right, you may not likely know is the break of structure, but you need the institutional presence, that candle that shows that they're active in the market so that you'll be able to align your imbalance zone, properly. This structure is very visible with 1 hour. It's very perfect. That is it. So what you have to do, you have to move to more hour time frame. So I'm on 45 minutes time frame now. I can't still spot what I'm looking for. 15 minutes time frame, 30 minutes time frame, I can't still see the presence of institution, but I know the structure, the broken structure is this region, right? Yes, but I can't find a present for me to know how to align my entry. So coming to 15 minutes, I was able to spot it. Now, I'm not going to discuss this deep in this topic because in this course generally because this is not the aspect or the full-blown discussion for this very topic or this course. This institution have this presence of institution signal have different types. So the stronger the candle, that is going to determine how strong is your entry. Sometimes the strength of this candle is going to determine how far the market is going to move deep into the zone, your entry zone that you're going to mark using the high and low of this candle, basically. So there are some types that will come, you know that you will need to set a pending order, and there are some type that will come, it doesn't require pending order. If you set a pending order, may likely kick you out and still return back. What does that basically mean? That basically means that there are some institutional present candle that you notice that you have to stay real time to monitor the trade to take their entry. And there are some that you notice, then you can set a pending order, right? In this case, pending order is perfect because price just move, then tap into the zone, then continue again to drop. There are some that this coming back to see the imbalance can go as high as above the zone or high of that institutional candle before you experience the drop in price or the continuation, depend on the direction that you are trading ahead. So that is basically how to locate imbalance, then a institutional presence in the market collectively. So knowing how to spot this is going to help to align your trading well. So our basic things we learn in this topic is institutional candle imbalance, or some strategy call it fair value gap. So these are the basic things for you to know. If you're able to notice these two things, this is very important. This candle is very important. Just the one, the bullish candle in the middle. This is structure. So if you're able to get a clue of what I just did in this place, do your personal research, take a test to see. And what happens is that whenever you see this in the market, the movement that is going to continue after the pullback is always crazy and strong because that is institution combining forces with retail traders to move the price at this point. It is applicable in two ways, both in the buy or sell, pressure. So that takes us to the end of this topic. See you guys in the next video. Thank you.